If you've ever tried to pay off your debt and it seems like you're getting nowhere, listen, I've been there. But I found a way to turn 30-year mortgages into paying them off in 5 to 7 years instead of the 30. We found a way to actually transform 6-year, 7-year car loans into people paying them off in 15 months. I want to share with you not only that, but I also want to share with you how you can turn those minimum monthly payments that you're paying into cash flow for yourself. So let's go ahead and dive in here. The number one thing that is killing people's cash flow is not knowing how to use the money that comes in. For instance, with the high interest consumer debt, some just follow the bank's plan, meaning they pay the minimum monthly payments and that's it. There is no strategy, there are no tactics. But in this example, we want to share with you what to do when you're faced with a $15,000 cash flow sucking loan, and each and every month you've got to pay the $414 each month because it's at 22% interest. So what we've done here is we're going to go ahead and use our line of credit, which is at the $10,000 at 9%. Now your line of credit may differ, and that's okay. You may have a smaller line of credit, or you may have a larger line of credit. The key here is to use the principle that we're going to show you. With this loan, we want to make sure that we are doing a debt transfer. Debt transfer. So we're taking the $10,000 from our line, from our lower interest rate line of credit, and we're switching that $10,000 with the loan. That's what we're doing. When you do that, you immediately go from $183, paying $183 in interest, to only paying $75 in interest. Now, that's about $108 saved in interest each month. Now, if you just did that one time, we're not talking about extra monthly payments, but if you just did that one time, you would go from a 5-year loan, which this one was, to about 1-year loan. I believe it's about 1.5 years is where we're staying on this, okay? But do you see how that simple change changed from $10,000 going nowhere, right? You have it, right? And now you're going to deploy it, and that's how you're going to make your money work for you. So that at the end of that 1.5 year period, this $414 after that 1.5 year period can now be going to you instead of the bank. Let's continue. So in this next scenario, we have an inefficient capital use, which the first letters, they spell ICU, and sometimes our bank accounts are on ICU because we have that inefficient use of capital. We're going to change that right now. So let's say you have $20,000 just sitting in your checking account. That's not what money is supposed to be doing. It needs to be moving, hence velocity, right? Have you ever heard of the velocity of money? This is what they're talking about. Instead of just sitting the $20,000 or parking the $20,000 in our checking account, let's go ahead and use that capital to destroy a mortgage. How about that? $200,000 at 6%, and that is if you don't have any more cash flow sucking loans, okay? We needed to insert that caveat. Of course, on the mortgage, we have the $1,200 each and every month, but a better capital use of that would be to destroy the principal of that $200,000. Why? Well, that brings it down to $180,000, which this interest will be eating on instead of the $200,000. Now, let me share with you something. I know those of you are like, well, wait a minute, now you're out $20,000. Well, what about this? What if we use our line of credit instead of our checking, so that if we wanted to park our $20,000 somewhere, we can actually park it in a vehicle that is going to be responsible for taking out our high interest debts, our cash flow sucking debts. And oh, by the way, when you are you're sitting your $20,000 inside of your checking account, you're actually losing money. That's why we inserted the negative sign there, because you're actually losing money as that money is sitting there. So we want to make sure that we're having the highest usage of the money that comes into us, of that capital. What does that mean? That means if you were to just do this one time, okay, $20,000 is actually going to save you $77,442. So as you can see here in the illustration, just that one-time payment, that one written check for $20,000 has actually saved you $77,442. Now, if you need something more customized, all you got to do is subscribe to the newsletter, and we will absolutely get that debt customization roadmap for you. All right, so let's continue on here. We're going to turn those minimum monthly payments into cash flow here for you. All right, so in this example, we are just going to be real with you. Sometimes our lifestyle creeps up on us, especially when we get a raise at a job, or perhaps the business is going good. Guess what? We went from $5,000 to $6,000 in income. However, guess what else went up? Our expenses. Isn't that something how that happens? So we went from spending $4,000 trying to be frugal with it. Now we're spending $5,800. Why? Because we have that extra money. My suggestion to you would be to go back down to the lifestyle of still having $1,000 in that surplus, so we have that cash flow there, but not just so that we could have the cash flow, right? Because some people stop there. Let's use the cash flow that is coming into us. Let's have that line of credit. Oh, by the way, we've got a mortgage. Now you can also use this on a car loan. You can use this for any loan, okay? $15K, we're gonna go ahead and do that debt transfer to where we're making sure that this principal on the mortgage is $185,000 instead of the $200,000. Why? Because we want the interest, the 6%, to eat on a smaller number versus a bigger number. Now, remember, you're paying with a line of credit. What does that mean? That means that you've got to pay the line of credit back. However, when you use your line of credit as your new checking account, that amount, $1,000 that you have now, right? It's going to be staying or being parked in that line of credit, so that is what is paying it down in about 15 to 16 months. So that you can pay that line of credit off and do what? That's right. We're going to go ahead and slam that principal one more time. When you do this, you're no longer going to be paying off mortgages in 30 years. This is where you go from 30 years, and can you believe they also have 40-year mortgages? Absolutely. And you and I both know why. But you're going to go from 30 years or 40 years to 5 to 7 years. So all of that money that went out, we know that $200,000 at 6%, that's that $1,200 we were talking about, okay, each month. All that money that goes out, if you're paid that off in the 5 to 7 years, that $1,200 each month is now going where? It's going to you. So my suggestion to you is this: if you're having trouble with paying off these loans and it seems like, man, there's nothing that I can do, I keep trying to pay extra each month, I want you to do something. I want you to go here and we're going to share with you how to pay extra each month if that's where you're at, okay? So we want you to go there. Next, we're going to be capturing that cash flow. So that's what we want to do. In each one of these examples, we've showed to you the car loan, we've showed to you a personal loan, we've showed to you a mortgage, so that that money that you're paying out, that $1,200 a month, we want to turn that into money that you are getting, which is possible with Velocity Banking. So go ahead and click on that video to learn how to pay the right way.